Seeing the recent Tesla performance of the shares, the stock is down about 25% in the month or from the peak. Three contributing factors. Number one, the earnings call. Number two, the price declines in China. And number three, we have a departure of the CFO. I think those are the three main. We could probably add a fourth one, which is the treasury, but the underperformance relative to the market, relative to the beta, is those first three factors. This is not even wrong podcast. It's August 17th, 2023. This is Krim Delco. Since the last update, we're down 18%. The market's down 2%. For the year, we're up 88.4%. The market is up 14.3%. We're outperforming by 74.1%. So Tesla shares are down about 25% from the peak. They're down since almost a month, I would say. It's roughly a month, actually, since the earnings call. So the peak was reached right before the earnings call. Then the earnings call kicked in, and since then we're down 25%. And I want to start with the earnings call. So the earnings call was disappointing for a couple of reasons. I think Musk's performance was just really bad. I mean, he was talking quite a lot of nonsense and reiterating the robo-taxi, those types of things. And we spoke about, is Musk sort of the boy cry robo-taxi here, or is there substance, or what's the story with the robo-taxi in general? And I think we as investors have to keep it at arm's length because we cannot really pay for it right now. But we know that this is a call option that could, it's almost a binary call option that if it kicks in, it can just triple the value of the shares in a very short period of time. So it's that kind of situation. We don't spend too much time on it at Orange Capital Partners because we try to understand the fundamental drivers of the shares and have a sort of margin of safety and keep that as a call option. Now, we also at Orange Capital Partners are of the opinion that the full self-drive itself is a value driver, even if it's not a robo-taxi. And quite frankly, on a tangent here, we question ourselves, why do we actually need a robo-taxi? In a sense, we already have the ability to rent Teslas and drive around in them. There could be a driver, but why aren't people doing that? And people are doing it, but it's kind of sluggish. Now, the concept of robo-taxi, of course, is, or the main value driver would be that, well, it's a lot cheaper, so it's going to pick up very quickly. And we do agree with that. But nevertheless, it's one of those things where you have to ask yourself fundamentally, really, is there a reason to believe that this could be a big game changer? And the answer is yes, because of the price. But we don't know. But by the way, what I mean with the price is simply that if you get rid of the driver, you're getting rid of 60% of the cost per mile of driven today in the U.S. And if you have the robot taxi operational, you also will have much larger miles driven, and this is a sort of utilization game. I mean, we've spoken about this months ago. The main premise of Tesla investing is actually higher utilization. The higher you utilize, the car, the dojo computer, the factories, the more utilization you have, the cheaper the per unit cost, the higher the margins. This is the real fundamental driver of Tesla. This is the ability to lower prices and still keep very high margins. So we don't think that the earnings call itself was concerning, but there just wasn't a lot of good news. There was quite a bit of riffraff by Musk. So given that the stock has been almost 300, so it's run up quite a bit, our fundamental value as of today is around 350. So we're now almost 50% below that. And we were 15% close to that at the peak. So there's definitely some risk adjustment going on. Now, we spoke about prices. The second factor that is driving the underperformance of Tesla is pricing. In China, we have discounting again. China is a problem for several reasons, but I think the main fundamental problem in China is, I would say, driven by higher rates in Japan. and a withdrawal of the carry trade between Japan and China. So you have a tightening of the monetary supply in Asia, in East Asia, and that is going to drive demand down in China. So this is, in a nutshell, I think macroeconomic-wise, probably the best explanation. What's going on the ground, we don't know exactly. Other stocks, other car stocks, other industrial stocks, China are doing weak also. So there's definitely some readjustment, and Tesla is, as usual, readjusting the pricing. The reason lower prices are bad for the stock is that we have expectations of lower margins, and also we have a signal for lack of demand. So the third reason that we have a stock underperformance is the departure of Zach Kirkhorn as a CFO. This was announced beginning of this month, pretty abruptly, and ever since the stock is down probably about 15%, and I think that's warranted. You have a very good CFO who has driven the stock up with his whatever he can contribute in terms of transparency, in terms of very clear earnings calls. We have a new CFO. You never know if there could be some buried suits that the new CFO discovers. You have risk. You have people maybe also that were fans of Zach that are exiting funds, etc. Now, I think those are the four main reasons. Whenever you have the departure of a CFO of that caliber, like Zach Kirkhorn was, and made himself be, you have a readjustment of the stock. But let's not forget, when Zach was reinstated as CFO, when Deepak Shuka, I forgot the previous CFO, left, we had the same reaction. So we don't want to overjudge this now, and we want to give this new CFO the benefit of the doubt, but nevertheless, it's a risk. Now, the fourth reason, again, is the treasury. I said that's a macro reason that is not driven by stock-specific things, but that doesn't exactly explain the underperformance relative to the beta. But nevertheless, we want to mention it. It's the treasury. The U.S. treasury, the 10-year treasury, has been up quite a bit in recent weeks, driven by macroeconomic events. I think the Japan situation is actually the main reason why we have higher rates in the U.S. The carry trade unwind as the main sort of bullet point here. We at Orange Capital Partners aren't macro investors anymore. Actually, we used to be, and we used to trade around these things quite a bit. I think we've ceased to do that, quite frankly, because we haven't been able to make money, but also because when Ben Bernanke started printing money at the Fed, macro investing became more difficult. I think there's probably an opportunity today to get back in the game, and we at Orange Capital Partners are contemplating starting to do some work. You can't just start trading these things. You have to do some work. You have to spend some time. You have to get a feel for currencies and commodities and interest rates and those sort of things. We believe that the unwind of the yen carry trade is definitely a very big event. It's going to drive monetary tightening around the world because the yen is the borrow currency of the world, if you will. You borrow in yen, you invest in around the world, etc. So there's definitely some of that. We could have some issues. I mean, even companies like Berkshire Hathaway are long the carry trade. So you never know where the cracks could happen when that carry trade unwinds. That is, I would say, just sort of a cautionary statement here. We've spoken about this weeks ago, and we said we are bracing for impact. And unfortunately, we were right about that. We at Orange Capital Partners are down. We're down roughly 60% since the peak. We were up 150, now we're up 88, so about 60-something% down. So we have a massive leverage against these types of events. Not leverage in terms of actual or credit leverage type leverage, but more operating leverage in the fund in terms of high beta, especially relative to rates. We believe, though, that the rate increases have plateaued. We won't see too many drastic rate increases without some sort of intervention by the Fed or by the just natural correction of the market. So to summarize, 3 reasons plus 1 macro reason, the 3 reasons why Tesla has underperformed in the last month. Number 1, a disappointing earnings call at the end of July. Number 2, we have price declines in China. Number 3, we have the departure of the CFO. And then the macro situation is just that we have higher US rates. That is driven by the unwind of the yen carry trade. Primarily, there's other reasons, of course, but this is the main reason. And that is contributing to the decline of Tesla. Now, where do we stand as investors? Tesla is our largest position. We have another position in NVIDIA, which is about 15% of the fund. We are long. We don't have short positions. And like I said, we are contemplating, thinking about looking into some macro trades, maybe around this opportunity that is opening up with the yen carry trade unwind. But right now, we are positioned as we've always been. And of course, we have a very long-term view of AI and real-time AI, meaning AI through NVIDIA and then real AI through Tesla. Those are the two main themes of the fund. Thank you.